Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The dollar has surged thanks to the Fed, stock indices are unstoppable, gold is set for consolidation, and Bitcoin is outperforming altcoins. The second consecutive cut in the federal funds rate in 2025 has once again strengthened the US dollar. Since the September FOMC meeting, the USD index has risen by 3%. In both cases, the greenback benefited from a reassessment of market expectations regarding the path of monetary easing. Before Jerome Powell's speech, the futures market was pricing in a more than 90% probability of a third cut in borrowing costs in December. But afterwards, the chances plummeted to 65%. In September, the FOMC forecasts helped the US dollar. In October, it was helped by the split that emerged within the committee. Kansas City Fed President Jeffrey Schmidt unexpectedly voted to keep rates unchanged. Pressure from the hawks is mounting. Jerome Powell is forced to acknowledge the persistence of inflationary risks. He compares monetary policy in the absence of data due to the shutdown to driving a car in fog. Whether he likes it or not, the driver has to slow down. Investors interpreted this rhetoric as a signal that the Fed's monetary policy easing cycle is nearing its end. This helped the bears on Euro-USD. The S&P 500 shrugged off Powell's hawkish comments. Thanks to a series of new deals, NVIDIA's market capitalization exceeded the psychologically important level of $5 trillion for the first time in history. The growth of the tech giant's shares and expectations of positive corporate reports from Amazon, Alphabet, and Apple outweigh the negative impact of the Fed's cautious move towards easing the policy. About 69% of S&P 500 companies that have already reported exceeded forecasts. This is the highest level since 2021. From its low in October 2022, the broad stock index has risen 92%. Impressive, but not excessive, compared to the dynamics of the previous bull market. The bulls are supported by the de-escalation of the US-China trade conflict and positive macro statistics. Data from ADP indicates a gradual recovery in employment after a serious cooling of the labor market in the summer. At the same time, the S&P 500 has been above its 50-period moving average for 125 days. Over the past 30 years, there were only 3 longer series. Coupled with investors' reassessment of the federal funds rate trajectory and rising bond yields, this increases the risks of a pullback. The strengthening of the US dollar and higher treasury yields have brought the gold price back below 4,000. Yellow metal is gradually losing its wildcards. It managed to reach a record high thanks to devaluation trading, expectations of aggressive monetary expansion by the Fed, Donald Trump's threats of 100% tariffs against China, geopolitics, pessimistic forecasts for the global economy, and active purchases of bullion by central banks. However, the White House is no longer attacking the Fed as aggressively as before. The United States and China have found common ground. The Middle East conflict has been resolved, and the global economy is proving resilient in the face of tariffs. The Fed is cautious about lowering rates, and central bank activity in the bullion market is declining. Gold rose just as rapidly in 1979 and 2011. The experience of those years shows that the surge and collapse were followed by long periods of consolidation. It is quite possible that after a short period of increased volatility, it will decline. As a result, the precious metal will find the boundaries of the trading range and settle within it. The split in the ranks of the Fed and the trade agreement between the US and China thwarted attempts by Bitcoin bulls to launch a counteroffensive. Bitcoin reached a record high in early October, thanks to the escalation of the conflict between Beijing and Washington, as evidenced by the White House's threat to impose 100% tariffs. However, relations between the world's major powers have since improved, and Donald Trump described his meeting with Xi Jinping as amazing. He halved import duties on fentanyl-related drugs. This resulted in a decrease in the average tariff from 55% to 45%. The rebound in Bitcoin, driven by capital flows from the gold market, altcoins, and the growth of technology stocks, has been a key factor for the last 2 weeks. Jerome Powell acknowledged that artificial intelligence contributes to increased consumer spending and accelerates GDP growth. It is not very dependent on interest rate changes. As a result, the stocks of tech giants rose, but this did not help crypto. The digital asset market is seeing an increase in concentration. Bitcoin and Ether are being saved by demand from institutional investors, while altcoins are being actively sold off. According to 10x research estimates, based on previous cycles, their capitalization should be $800 billion higher than it is now. The reasons for this are related to the outflow of money into cryptocurrency-related stocks. Following the US, Canada, the Eurozone, and Japan, the central banks of Australia and the UK will follow suit with their rate decisions. The Reserve Bank is not expected to cut its key rate after the unexpected surge in inflation down under in the third quarter. There is a prevailing view in the market that the RBA's cycle of monetary expansion has come to an end. Coupled with the de-escalation of the US-China trade conflict, this is helping the Australian dollar to rise. The Bank of England is in limbo. There is more division within its ranks than at the Fed. Rumors are growing in the markets that the repo rate will be lowered at some point, despite high inflation in Britain. This is putting pressure on the pound. Growing concerns about tax increases and government spending cuts in the updated budget are also contributing to the decline in the value of the pound. Investors will continue to reassess the Fed's rate trajectory and savor the details of the meeting between Donald Trump and Xi Jinping. Follow the updates on global markets in Pro News Weekly. Like, share, and subscribe.